Redondo Beach Budget and Finance Commission meeting, November 10th. Doug, can we do a roll call, please?
Commissioner Conroy,
Here.
Commissioner Jesse,
Here.
Commissioner Castle,
Here.
Commissioner Woodham,
Here.
Chair Marin,
Here.
Commissioner Samples,
Here.
Commissioner Solomon.
Present.
All right, let's take a moment and do a salute to the flag. Please stand. Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Great. So item D, approval of the order of agenda. Are there any questions or comments regarding the agenda? If not, can I get a motion to approve?
So moved.
Second.
All those in favor?
Aye.
All those opposed? All right, item D is closed. Item E, blue folder items. Don't see any blue folder items. Is that correct, Doug?
Correct. There's no blue folders tonight.
Okay, great. Then item F, the consent calendar. We have two items, the affidavit for this evening's Budget and Finance Commission meeting, November 10th, as well as approval of the minutes of the Budget and Finance Commission meeting, September 19th, as well as October 13th. Are there any comments, or does anyone want to pull anything from the consent calendar?
Mr. Chair, I'll just be abstaining from voting on F2.
Okay.
If you wanted to separate them, I was not here at the meeting to approve the minutes.
Okay. So we can go ahead and maybe vote first on F1.
Actually, with the consent calendar, you can do all items at one time.
Okay,
So usually with the consent, you don't need to do a roll call vote. You can
okay, just, okay,
make a motion.
no problem.
Move to approve the consent calendar as written.
I'll second.
All those approve?
Aye.
All those opposed?
Abstain.
Great, moving to, what is it, item G. There's no excluded consent calendar items. Item H, public participation of non-agenda items. This area is intended to provide members of the public with the opportunity to comment on any subject that does not appear on this agenda for action. Are there any comments? Or Doug, any e-comments?
We don't have any attendees or comments on Zoom. We do have one e-comment. The e-comment is from Mark Nelson. The city of Redondo Beach is failing to exercise appropriate controls over Beach City Health District. As the largest city in the district and as the city that has sustained 65 years of damages from construction and operation of the failed hospital district and conversion to BCHD, it is incumbent on the city to protect its residents. No City of Redondo Beach employees or commission members should be allowed to serve on any BCHD committees. That is a conflict of interest. And that's the only e-comment.
Any comments or feedback regarding the e-comment?
No.
All right, motion to approve item H, or to close item H, public participation.
So moved.
Second.
All those in favor?
Aye.
All those opposed? Great. Item I, items continued from previous agendas. There's nothing. So we will move to item J, items for discussion prior to action.
Mr. Chair, I have a question on item I. At our last meeting, didn't we decide to continue the discussion regarding a possible bond issue to this meeting?
That does sound familiar.
Sounds pretty familiar.
Yeah, we did, and we had decided to send a word to city council. Did that word transfer take place, and what response did we get? Obviously,
okay.
They couldn't be here tonight.
We can discuss it now, or we can discuss it at referrals to staff. I wasn't sure when you want to talk about
It's not on
that.
the agenda. I think we discussed it during referrals.
You want to do the turn referrals?
Well, it was meant to be continued to this month because we asked to have a discussion with the city manager and some department heads at our meeting right now because it sounded like it was rather important to make some decisions and recommendations to the council. And so I'm curious what's happened to that.
Okay, so for us to bring it back as a item for a continuing item for discussion, we'd have to agendize that. I know we talked about it in the last meeting when we were talking in referrals to staff. I said I couldn't make any promises based on the schedule of the city manager and the city engineer. I've discussed with the city manager on the topic. That initial discussion in the last meeting was kind of just an open conversation, just to give you guys an idea of what is coming in the future, but it wasn't something that was pressing that's going to happen in the next couple months. And so I thought we could discuss further in referrals to staff.
Then I was mistaken, and let's see if we can discuss that in staff referrals.
Yeah, I think we were thrown by the wording in the introductory was that the city council was expecting an opinion or a recommendation from Budget and Finance ASAP, which made it sound like there was a degree of urgency that apparently is not there.
Correct.
Okay.
When will city council be making a decision on the bond issuance?
Well, first it's going to have to come to your commission here. I don't have a date or, that's something that hasn't been determined.
Anecdotally, I haven't seen them bringing it up in the last month or so, beyond the referral to this body.
Okay.
Okay.
Great. Motion to close item I. Items continued from previous agendas.
So move.
All those in favor?
Aye.
All those opposed? Great, then we'll move to item J, discussion of items for discussion prior to action. J1, City Treasurer's Quarterly Fiscal Year 22-23.
I'll do the introduction and let you go. Okay. Well, hello, Budget and Finance Commission. It's a pleasure to be here, presenting to you the fiscal year 22-23 quarter one quarterly report. I am Stephen Deals, Redondo Beach City Treasurer. I have with me Nilesh Mehta, Chief Deputy City Treasurer, and also we have virtually here for color commentary and some expertise on the matter is Rick Phillips, our consultant from FHN. And Nilesh can take it away.
Good evening, all. So tonight, within your report, you'll see the quarterly admin report, which includes the portfolio summary, investment reporting guidelines, a report by FHN Main Street, which includes the portfolio summary, policy compliance, investment activity report, as well as the economic and market update, which we'll go over shortly. And within your PowerPoint presentation, you'll see the investment reporting objectives, policy compliance, quarterly performance, historical book value, cash flow analysis, month-end portfolio book yield, maturity distribution, trading activity, and finally, the fiscal impact to the city. So as you have all seen, I believe we have one new commissioner, so I'll just go over the key investment objectives for general municipal investing. The city treasurer maintains the city's cash flows while earning a competitive rate of return on the investments within the constraints of the city's investment policy and state law. So it's very important to keep in mind that safety, which is the protection of principal, liquidity, which is providing the necessary liquidity.
Safety is the highest priority.
Safety is the highest priority, yes. And liquidity, which comes number 2, is providing the necessary liquidity to cover ongoing and unexpected cash needs. And finally, it's yield, which is maximizing the earnings.
So we are trying to emphasize to you all and to the public the importance of liquidity because everybody jumps straight to yield all the time. So it doesn't matter how much we're earning if we can't pay our bills with cash. So we always want to re-emphasize the importance of safety, liquidity, and yield in that order.
It's important to remember that whose money it is, it's the community's, not yours. So we have to act accordingly in a responsible stewardship capacity. Investment managers' objective is to earn a reasonable rate of return on the city's investment while preserving capital in the overall portfolio. As Steve mentioned, it should never be the investment manager's goal to earn maximum returns on the city's portfolio, as this would expose the city to an unacceptable level of risk. And to continue, failures in public investing occur. Policies are not clear, policies were inappropriate, policies were not followed, and oversight was inadequate.
Or in some cases, we might take it for granted that we have a policy. Some cities don't even have policies.
And here's a few questions to ask. Do you review the investment policy? Do you understand the city's investment program? Do you receive and review periodic investment reports? Are they clear, concise, and are they readable? Do you fully understand them? So if you have any questions, please feel free to ask.
There's an important point in here I would reiterate. It's our job to make sure that this stuff is presentable, so that this makes the point that if you don't understand it, it may not be you. It may be our inability to clearly present to you. So it's always good to ask questions, and we've come a long way, I think, to simplify these reports to make sure that they are understandable. Not that you don't have the experience and intellect to understand things in a more complex manner, but when I got started in this, the presentation was literally charts and charts of numbers, and that was it. So we're trying to make these points as clear and concisely as possible.
The following slide goes over policy compliance. As you'll see on the right-hand column, we have been in compliant for the previous quarter for all of our various policy within our guidelines. So you'll see on the right-hand column, we have been in compliance, and I'll go over the details of our portfolio in the next slide.
One question
Yes.
on the policy compliance. You all had a compliance slide in the reports last year that was a little fuller than this. This has two things that I found that are on that prior slide that aren't on this one. For instance, under the weighted average maturity, the weighted average maturity is 1.99. You say we're in compliance. It'd be helpful to show what the requirement is, and that the requirement is no greater than 2.5 years. So I'd suggest putting that on there. And then on the liquidity, there's a requirement to be 25% under 365 days and 50% less than 3 years. At least make those changes to that report. The prior report, which took up more of a page, doesn't tell you anymore, but it had those particular pieces in there. So I'd suggest either going back to that prior report or adding those two items to this one.
Okay, sure.
Also on that same slide, under the LAIF for percent allowed by policy, it shows 65 million instead of a percentage.
Yeah, it's not a percentage, it's just an exception.
No, I know, but it should be a percentage, right?
No, because we don't have a percentage requirement for LAIF.
Okay.
So we're just letting you know that it's there. We do have a percentage requirement for liquidity. So it could be more clear. I think that stands out, and it's a very good question. But that's where we stuck it, even though it's not a percentage.
Nilesh, when you're, for the compliance on the commercial paper for our corporates, some of them are being redeemed now. We'll have one with Toyota. Is this also forward-thinking, where we don't expect to purchase any commercial paper in the course of the next 12 months?
No, we don't think like that. We don't plan on not purchasing any in over a 12-month period. And we don't have a requirement to own corporate paper.
So
But
that
if we
zero is a
do,
reflection of our
we can
current
only have
portfolio.
25%.
So it's a reflection of our current portfolio holding.
Was that at the
Yes.
end of the quarter or is that current?
End of the quarter.
End of the core, but at any time, we're not supposed to have more than that.
I guess do you envision changing the mix anytime soon, or is it kind of, this is generally the,
We are changing it. We're in the process of moving some money out of LAIF into a money market because the returns are so much higher right now. But we're more opportunity oriented with our allowed investments. And Rick is going to be a good one to ask that question to because he knows the whole market better than I do, frankly.
Yeah, in previous years, we were more heavily weighted in corporates.
Okay, so this chart goes over the first quarter performance for the fiscal year 22-23. We had just under 11 million cash in banks and money market. LAIF, 16 million. Federal agencies, 53 million. Corporate medium-term notes, almost 7 million. And CDs, 1.2 million. Treasuries, almost 33 million. And as we mentioned, the weighted average maturity, 1.99. The portfolio effective rate of return, 1.51. The LAIF yield, 1.6. The benchmark yield was 0.97. Interest earned year to date, as well as the general contribution, I'll go over in the following slide. And here's a comparison to the previous fiscal year.
Whoa.
Yes.
Wait, go back one.
Okay.
Okay, the general fund contribution, I just would like to point that out right now because this is part of the dynamics I would like to emphasize. You just kind of stated it and moved on. But
Okay, so interest earned year to date, 425,000. And of that, we contribute 60% to the general fund. So it comes out to 255,000.
and we budgeted,
I was to say, how does that compare to the budget?
okay, so when we budgeted, interest rates were quite a bit lower. So we budgeted $750,000 for the entire year. So we're already at,
See that.
Yeah, 425 in the first quarter.
yes. So interest rates, it appears, are going to continue to go up, and we've already made a quarter of our budgeted amount. So we've obviously under budgeted, but given what the interest rates were at the time,
Of course. Yeah.
this is what we selected. So, and that's part of the dynamics that I want to point out that are super interesting going forward, but go ahead.
And this is just a comparison to the first quarter of last year. So,
Hey, quick question
Yes.
on the checking account. We show the cash and money markets, 10 or 11 million. Have you all done an analysis to determine, is that the minimum we can get by with? Are you sure we don't have any excess cash in the account?
Yes, we do a cash flow analysis, and we know when cash is going to be arriving, like we're about to get our property tax increment coming. And so we invest what we can as long as we have a comfortable amount of cash available to meet our liquidity needs. So could we dial it in tighter? Perhaps, but
Well, it's not been an issue until now because we were earning about 0.1% on excess cash.
yeah.
But that's becoming, money market rates are higher now, so that's something to keep your eye on, I guess.
We're looking at a sweep account that right now we were just quoted at 3.6%.
Okay.
Nice.
Yeah.
I have a question.
yes.
In looking at the first quarter of the prior fiscal year versus the current, the interest earned is pretty, what do we have, 498,000 compared to 425, was it, for this quarter?
At that time, the effective rate of return was 2.25% compared to 1.51%.
So does that have to do with the allocation between this year and last year? I mean, because our interest rates are up, but our yield is down for the same quarter last year. So last year we made, what was it, 2.2%, and this year we made 1.5? Is that,
Yeah, that's what it says. You know, I don't have an answer for that, frankly.
Well, the balance is much higher.
Well, yeah, that's going to be a factor, but it's 110 now. What was it?
It was 84.
Yeah, that'll be a big difference there then.
So it's 20% higher.
Yeah. And so actually go back, what slide do you have up? Yeah, go to the next slide.
Next slide, this one?
Yes. So speaking of balance, so if you look at June of 2019, right before COVID, look at the balance, it was over 100 million.
right?
And then COVID hit, and we're down in the 80s, 79, 80s. And now we're back up, you know, to actually the highest level that I've ever dealt with, and we're at 113.9. So it's very interesting what's happening here. And part of the drop in the overall value is because we took a bunch out for the the retirement fund,
CalPERS.
the CalPERS.
Right.
So that was part of the reason for the drop, not just the
Change in yield. Okay,
yeah,
I
not
see.
just the COVID effect on the economy. But anyway, but that said, I mean, things are looking really good from a portfolio standpoint. It's really going up in value.
I guess just one follow-up question, you know, because inflation right now is, you know, much higher than it was this time last year. And although our interest rate is going up and the yield is going up, it's still, you know, we have roughly a 6% drag on our principal amount. And since the first, you know, principle of your investment guideline is safety and protection of principal, is there anything we can do within the allocations to sort of maximize return but still maintain our current policies?
Well, that's exactly what we're doing.
Okay.
Inflation is more a factor of the spending side, which is the budgetary side. That's what the city council does.
Right.
So they're dealing with spending. I'm not, fortunately. So
Well, I guess what I'm saying in terms of overall, you know, the value, if we have $100 million value this year, 8% inflation, it sort of eats away at the value of that $100 million for next year. So we're sort of.
on the spending side.
Right.
Right, but we're not dealing with spending. You might, because you're dealing with the city council and making advice to them, but not me.
Right. Okay.
I'm just strictly on the revenue side.
Okay.
But that leads me to the point that I wanted to get to, which is the value of the portfolio.
Right.
So during inflation, during times of interest rates going up, the value of our existing investments tends to go down on a mark-to-market situation. So when that happens and things get political here, what happens is people accuse the city treasurer of actually losing money for the city because the value of the portfolio goes down. So this is a great opportunity to point out that the actual returns go up as interest rates go up, and our portfolio is not for sale. So it's as if you owned rental property, right? And the value of your property goes down, but your property's not for sale, right? But your
Paper loss.
right, it's a paper loss only, but your rental income goes up, right? So right now, when we're showing, and this is the dynamic, and this is exactly how it works. When interest rates are going up, the value of the portfolio drops on paper only, and we have a requirement to do mark to market, right? But because we're reinvesting as things mature and our new cash coming in at a higher interest rate, our returns are increasing. And that's what we're seeing. And that's why we got $255,000 in returns, 1/3 of our projected income in 1 quarter. And so that's it in a nutshell, and that's the dynamic I wanted to point out. And we can, actually, since I'm talking about it now, the mark to market is pointed out on page 20 in the actual administrative report for the quarterly report. Let's see, I think it was page 20. Yeah, it's actually the second page of the administrative report. This is where we do the mark to market. So city treasurer's portfolio summary, the market value of the city's general investment portfolio changed. We use that word, we use that word on purpose, to 105.89 from 105.96. So it's a very slight drop in the value of the portfolio. But we haven't lost any money, right? It's just the mark-to-market reporting requirement. And yet you're seeing the increased, finally, we're seeing an increase in interest rates. I mean, it's been a long time. I've been predicting this for 12 years.
You're finally right.
And I'm finally right. And I know that when you're right too soon, you're wrong, but at least now I'm right. So, but in any case, here we can finally show you what happens in a rising interest rate environment. It's pretty exciting.
And Steve, conversely then, when interest rates are trending downward, the value's going to look inflated.
Exactly. So the portfolio goes up in value, and yet you're making less money. And then people say, oh, you're making money for this. No, you're not. You're making money when you make good investments, and you're really maximizing your portfolio to maximize the revenue, given the constraints of your policy and the law and your cash needs. But right now, and that's a great point. So it looks great when interest rates are dropping, because if you're looking at the value of the portfolio, it's inflated. But again, it's not for sale. We're not selling our portfolio. We need that cash. We're just investing it in the interim before we have to spend it. So,
I'm curious about rate of return. This quarter, you show an effective rate of return of 1.51%. And when I look back across the last 1, 2, 3, 4 years, that's the worst performance with the exception of one quarter. Can you explain how and why that happened if interest rates are going up and we're getting more return on our investment?
and that's exactly the dynamic we just discussed. And that because we're hold to maturity investments, right? So we're stuck with the returns that we've already invested in, but as they mature, we invest at a higher rate. So we've hit bottom, and you'll see that climbing going forward.
Our portfolio mix will affect that also.
So yeah, there's a lag before you'll see that, except that you're seeing it in the returns already.
Well, the thing is, the dynamic is working here is that as those rates are going up, to your point, the value of some of our fixed income is marked down.
Exactly.
So on a steady state basis, if you go from for one quarter and do nothing but increase interest rates and don't reinvest any money, on that quarter your return suffers because you lose capital. But to Steve's point, since you don't sell that, eventually you make that back, but there's a lag.
Yeah, and it's also it's another dynamic. It's like comparing a balance sheet to your income sheet, right? Your income statement. So the value of the portfolio is like a reflection of your balance sheet, but the return shows up on your income statement. And I don't know, that's just a comparison there.
Some securities you might buy at a discount.
Yeah.
And there'll be a full value at maturity.
Right. So I guess the other half of that question is there a particular reason that we always hold to maturity and we don't pull the trigger early?
Yeah, because we don't time the market. So the only reason we would, we loosened the policy a couple years back to allow us to do that periodically, but we are a fixed income investment investor. That's what we do. So we're not in the business of timing the market, and we are in the business of safety, liquidity, and yield. And so given those constraints, I mean, you can spend all as much time as, a lot of time and energy trying to time the market, but it is risky. So yeah, we don't do that.
The investment policy statement addresses that and basically says you're a hold to maturity investor, and it lists, I think, a couple of cases where we can sell ahead of time if the quality of the bond goes down, if we have questions about the company.
Yeah.
But it pretty much says you don't try to you don't sell when the value goes up just to capture a gain.
Okay.
Plus, if you did that, you'd have to purchase something else anyway, so you're going to be right back where you started. So if the value of the bond's only either higher or lower based on the current interest rates that are being offered on bonds now. So to Commissioner Woodham's point, only if the underlying company was of concern, right, then you would look at selling before.
Okay, thank you. Liquidate before you become a creditor.
So this slide goes over the historical book value. You'll see that we are over the course of, since July 2009, we're at the highest point. And just shows you a historical book value of our portfolio.
Yeah, same thing we've been talking about just over a longer period of time, since '09.
On that last slide, do you have any sort of
go back?
forecast or assumption as to where the book value is going to continue over the next few months?
It has to do with spending. So you'll see it'll drop as we start spending. So we peak and then we start spending and it goes down. So that just depends on the normal cash flows of the city, but overall the trend is up and I think it's going to continue that way.
Looking in prior years, I see oftentimes where July is where some spending is reflected. So, and here, looks like, is the last data point on here July 22? Am I reading that correctly?
Well, this is ending September.
Yeah, no, it includes September.
It include, yeah. So,
Okay,
yeah, if you look.
so that's through
Yeah.
September.
Yeah.
Okay.
Yeah, and July it's a revenue desert, really. Kind of, right now we're getting November, December, we get so much of our revenue. Yeah.
And then as Steve mentioned, here's a summary of our cash flow analysis for the last 3 months. We have met the cash flow needs of the city for the quarter and expect to meet the expenditure requirements for the upcoming period.
And we added that this time, that statement, just to reiterate the importance of meeting cash flow needs because so often people jump to yield, yield. We're not a stock market investor.
This slide goes over the month-end portfolio book yield. So you'll see at the end of September, we're just over 1.8% in comparison to the previous fiscal year.
Same thing we've been discussing,
Yeah.
it's just a chart, graph, I mean.
And this chart goes over the maturity distribution of our portfolio. We have 37% of our investments maturing within 1 year, 19% maturing between 1 and 2 years, 12%, and so on. Trading activity for the quarter. So we had 2 purchases and we had 2 redemptions for the quarter. As we mentioned earlier, this is the fiscal impact to the city. Interest earned, $425,000. We contribute 60% of that, so that's $255,000. A budgeted contribution for the entire fiscal year is $750,000. So we have Rick Phillips from FHN on Zoom, and he should, Rick, can you hear us?
Wait, can you go back to
yes.
the trading activity?
Trading activity,
I think you misspoke.
2 purchases and 2 redemptions for the quarter.
Oh. Yes,
Yeah.
that is correct.
3 in August total.
Yeah.
Again, I guess with those purchases, are you just replacing them for like-kind assets, or are you changing again the mix? Are we looking at different assets? How are we looking at it this quarter or even the rest of the year based on where interest rates are at, or even where we're going to go into with FHN? Like, how are you changing what you're buying, or how are you choosing what you replace it with?
We are just taking a look at the overall market, seeing what's available. And we don't sit on cash. Usually when something matures, we buy something right away. And that's a good question for Rick, because he's the one that's scanning the market all the time. And he'll say, oh, there's a really good Toyota or Honda right now, or treasuries look good, or we want to put it out a little longer on the
Yeah.
on the yield curve right now to, make sure that we're staying in the policy.
Right
So
mix, yeah.
it depends on all the dynamics there.
See, a quick question. Go back to the previous slide. There's something that I've been wondering if we couldn't add to your report. The second bullet here shows the general fund contribution rate is 60%. You're saying that roughly 60% of the investment portfolio belongs to the general fund, right?
That is correct.
I'm assuming that in order to allocate income back to whoever invests in that fund, you have to have at the end of each period or through each period, detailed information on who owns all the other pieces. For instance, I'd like to see a chart that shows who owns that other 40% on a quarterly basis. You're investing for a group of clients, and those clients are the general fund, the 60%, and other entities within the city of that other 40%. I assume you have such a chart.
I have one critical comment about your comment, and that is that you've asked that before and we've not done it. So now that you just reminded me, we should be doing that because it's a natural question. And you have asked that before, and I think we said we would do it, so I don't think we took the note.
40%, you're asking where the 40%?
Let's just do a chart showing end of the quarter, whatever the portfolio is, 110, 105, 95 million. What percent of that, the clients who own a certain percent of that?
So
General
the way
fund's
we
gonna
do,
own
it's a
60.
little simpler than that. And it's really just when we get cash, if it's available, we invest it. And then the calculation is based on the size of all of the various funds, and it's allocated simply on that basis. But to demonstrate that, we can, it's a fair exercise. And you have asked it before, and we didn't do it. So you're
Well,
reminding
again,
me.
I'm certain you have the data, just a bit of the issue of putting it together, because you have to allocate back to those other 40%. And the general fund isn't exactly 60%. So you allocate back on a monthly basis the earnings based on the percentage of the fund that they own.
Yeah.
So
It's a good question. So sorry we didn't do it before. Do you remember asking that before?
Okay, so I have Rick on Zoom, and he's going to continue with our presentation.
Nilesh, do you have it, or do you want me to share my screen? How do you want to work the technology?
No, I have it. Can you see it?
Okay. I was seeing your presentation. It just says staff computer right now. Oh, there it is. Okay, very good. I'm just going to read off mine because it's kind of small.
Rick.
Where I'm looking.
Hey, Rick, go ahead and share your screen. Then you
Okay.
can control what you're talking about.
Right,
See if,
let me do
I'll
that.
just see if it even works.
Does it do it?
No.
So that's a picture of Rick right there.
Is that right?
It's showing. It's showing I'm sharing on my screen, but
There you go. There's Rick.
There, now we have something.
All right, good. Yeah, we can see you and see your slide.
okay. I'm gonna take my camera off so I'm not distracted. All right. Do you see the slide? Okay, now.
Yes.
Yes.
Okay. All right. Okay, so I've been investing public funds since 1989. I started there as the chief investment officer at the city of Las Vegas. So 33 years now. And the last 2.5 years have been the most unique and interesting. And that's counting the Gulf War, .com recession, Great Recession. It's just been quite an amazing circumstance to have all the stimulus we've had, the inflation we've had, rates going to zero, Fed buying junk bonds. It is, I hope we don't have to go through this again, but it's interesting how things repeat. So on page 2, and hopefully you guys have this in front of you okay, do you see it all right?
Yep. Yes.
Okay, so just a quick snapshot of what's gone on with the certain metrics of the rates market and the economy this year. So the Fed has raised rates from 0.25% all the way up to 4%. They were only planning at the first of the year, and this was the market's expectation when Steve talked about timing the market, of 225 basis point hikes, so to get to 75 basis points. We expect the Fed to go more, and I'll show that slide in a minute, even higher. So quite just remarkable increase in rates. The 3-month Treasury bill went from 4 basis points to 410. 2-year Treasury up 400 basis points. 10-year not up as much, 260. That's inverted the yield curve. I'm going to talk about the ominous signal of that. We know mortgage rates have more than doubled. They actually came down today with our weaker CPI report, just slightly below 7%, but still the cost of a home has dramatically increased for a buyer. And that you see the home prices on a year-over-year basis have come, they're still up, but they're coming down. And that's mainly because existing home sales, which is about 80% of the market, have really come down a lot. GDP has slowed dramatically on a year-over-year basis, 5.7 to 1.6. CPI, we got down to 7.7 today, better than expected, so that's a good sign, but still really elevated compared to what the Fed's target is. Unemployment actually went up. We got the number on Friday to 3.7. And stocks had a great day today, up 5% on S&P, up 7% on the NASDAQ, but still down a lot. So, and I'm going to pause here and there if you guys have comments or questions, but I love this saying by Mark Twain, history doesn't repeat, but it often rhymes. So we look at cycles just to give us an idea maybe what will happen, and we mainly buy to match cash outflows. We'll do a little bit of timing here and there with the portfolio, but it's mostly we're matching those outflows of the cyclicality of the cash flows.
Rick,
So
a quick question, please.
Yes, please.
Thank you. It's Eugene Solomon. On the GDP you listed here as year over year, we had a couple of quarters of 0 or negative GDP. In the last quarter, GDP was 2.6. Are we thinking that was anomalous, and that we're going to fall back into 0 or negative growth, and that's why the prediction of recession in 2023? Or we're looking at year over year negative growth, and that's the reflection of it falling into recession?
So, and sometimes people do think, just to back up a little bit there, we had that minus 1.6 first quarter, minus 0.6 second quarter. They think back-to-back quarters are recession. Now, typically that's been the case. It's like 16 of 18 cycles going back to the 40s. But GDP, when you look at the GDP number, it has, you subtract out inflation. That's when we had really high inflation, those first and second quarters. And so that was part of the reason. But to your question, my third expectation, we do expect to have negative year-over-year GDP in 23. And we will be in a technical recession by the folks that date them, the National Bureau of Economic Research, INVER.
Okay, thank you.
Yeah. Partly why we think that will be the case is the Fed stays hawkish and hikes rates to about 5.5%, and they don't ease in 23. I'm going to get into all of these a little bit more. We think disinflation gets down to 4-ish% by the end of 23. The market and the Fed are thinking about 2.9%. We think housing is going to be a sticky inflation, and it's the biggest component of CPI. I talked about growth. Supply chains continue to improve, helping inflation move lower. Unemployment rises from our 3.5, 3.7 low we just had up to the mid or high 4s by the end of 23. The dollar stays strong, assisting inflation to decelerate. Consumer spending rate of change continues to slow. Homes prices and sales continue to decline, and the global recession goes into economy in next year as well. The International Monetary Fund that's what they're predicting. So we'll see how these predictions come true. It's always challenging. Next page, just to look at inflation and interest rates. The 2 years are benchmarked for the portfolio. So we see, I did this slide deck last week. We came down to 7.7 today, still very high. And the 2 year, it actually dropped from 4.7 down to about 4.4. And you see there's a general correlation with interest rates and inflation, but sometimes they're even inversely correlated. In fact, you look back at the start of my slide in 2000, we had the 2 year well above CPI back then. We had deflation, so negative inflation back during the Great Recession, but look how much it has spiked because oil went to about $150 a barrel, and then we just cratered with inflation going into the Great Recession. We don't think we're going to have that kind. We will be surprised if we see deflation this next year during this cycle. Just some factors. The primary drivers of inflation have been the fiscal stimulus and somewhat supply chain challenges, and enhanced by Russia-Ukraine, particularly driving inflation really high in Europe, but impacting international food and energy prices.
Do you see a little stagflation maybe mixed in there with rising salaries?
Yes, yeah. I mean, stagflation, the definition is slower growth and higher inflation. We think inflation is coming down, but not enough. So we will have a stagflation next year and somewhat of a recession, we think. So the massive fiscal stimulus is done, and consumers probably won't be as strong. So predicted.org is a betting market on elections and other things. And so this was last week. It was still undecided, of course, with the House, but you bet 89 cents if you think the Republicans are going to control the House, and you get $1. If you want to take that big bet, you take 13 cents to buy the Democrats. Now that has come down with the uncertainty of the outcome, but it's still, I think it's 77 cents today. So essentially 77% probability the House will go. The Senate, that's looking more to the Democrats, but there will be gridlock in DC, most likely, it looks. So therefore, not this massive stimulus. And you see my top left chart here, the personal savings rates back down to normal-ish, that 5%. But these three huge stimulus checks that we had with CARES and ARPA funds and stimulus got dumped into people's checking accounts and businesses and really spiked up. But those have been spent. There's still savings out there, but you just see the dramatic decline in that. And so what's fueling spending? Consumer credit. Credit cards are at the highest level since 2011. And so that can be good. Sometimes people are feeling confident, but when the economy is slowing, that's usually not a good portending for the economy ahead and consumers. M2, money growth. This is interesting to see this correlation. So the blue line with the right-hand scale, it's the year-over-year change in the money supply. M2, defined by Investopedia down here, it's personal checking accounts, deposits. They have traveler's checks. I don't know if anybody uses traveler's checks anymore. But money market funds, not like the city would have with millions of dollars in it, but just our personal accounts. And I pushed this forward 18 months because there's usually a lag when the money supply gets kicked out or reduced with what happens with CPI on a year-over-year basis. So you see very correlated on this chart. And this is a good sign that we should see lower inflation over the next year or two. Again, probably above the Fed's target, but we should come out of these really high inflation numbers. Supply chain challenge is getting better. Shanghai to LA shipping rates are sinking. The dollar for a 40-foot container box spiked to over 12,000. You guys live by the ports of Long Beach and LA. That was just a mess. It's much, much better. Global economy is slowing, so demand is helping bring this down as well as just the supply chain is getting better to unload ships. So the Fed has two mandates, which is stable prices, that's inflation, and the target is around 2%. And they also have unemployment's target around 3.5 to 4.5%. So I drew the target over here on the left. We're in the target zone for unemployment. That ticked up to 3.5, but we're well within their target zone. Of course, CPI at now 7.7, still well above target. But if you look on the right-hand side, this is Bloomberg survey forecast, lots of strategist economists, our chief economist, one of them, is there with the survey is, and the Fed's really close to the Bloomberg survey. We look at CPI coming down as we get rid of those really high prints earlier this year and getting down to about 2.9% at the end of next year. Unemployment going up only from 3.5%, now 3.7, to about 4.4. So increasing from its low, only 0.9. We think both of those are going to, unemployment is going to be higher and inflation is going to be higher. And so still keeping the Fed hawkish. Okay. So I was kind of curious looking back at the cycles where we have data, and the thread is the Federal Reserve Economic Database the St. Louis Fed does. It's free. It's just a great resource. We have Bloomberg, but I like to use this a lot too. So I went back to where we have the monthly data started after World War II, and I'll just highlight this first one. So the low of this cycle was unemployment was in May of 48 at 3.5%. The high 17 months later was 7.9%, so an increase of 4.4%. And you can just see all these cycles, the highs and lows associated with recessions almost always. Of course, the big spike with COVID. Now, the average increase in unemployment is 4.4%, but I took out this big spike of COVID. The average is still 3.7%. The Fed and the market thinks we're only going up 0.9% from our low of 3.5%. So that's why we think it's higher, but not probably as high as normal recessions, because we know how hard it's been for employers to get employees. And so they might be reluctant to let some of those go. We know a lot of the big tech companies are letting go, but unemployment can happen fast. You just see, we'll go along, we hit these bottoms, and then they just spike, and employers just say, we got to shed jobs and just save expenses. So that's something really to watch. And the employment market is such a challenging one to gauge this cycle. Inflation, let's drill down a little bit here. So Pew Research has this great infographic looking at components of CPI. This is overall CPI. Shelter being our housing component, about a third. Food, 14%. Energy, about 7.5%. Why I put stars on those, they exclude those when they count core inflation, and they look at core inflation a little bit more because the volatile food and particularly energy sector. So let's drill down and look at this major component of inflation. And so this is the Case-Shiller Home Price Index. On the right-hand scale, home prices increased year over year. The peak was about 21% earlier this year. The data's lagged 3 months, so this is August data, so as soon as we can get. Then they have, how they measure housing inflation is they don't look at house prices, because not everyone's buying a house every month like you're shopping and gasoline all the time. And you think about it, well, the average mortgage rate in the United States is 3.6%. And so I feel sad for the new homeowners having to have higher prices and 7% mortgages. But so what they do is they ask homeowners, what would you rent your house out for? And you come up with an owner's equivalent rent. And then they're also asking people that rent homes and rent apartments, what are you paying? Those are a little more realistic in the sense that, hey, this is dollars going out, not a guess. But there's a lag, the way they collect the data and just how housing prices and rent prices work through the way through the economy. Because I could have signed a lease for my apartment a year ago and it doesn't renew, and now and rents are higher. So you just see that lag. And in fact, we've got today's data, and owner's equivalent rent with CPI softening, it went up to a cycle high. So it got up to almost 7% on a year-over-year basis, the housing component of CPI. So we think we'll see housing disinflation next year, and in some markets actually deflation, like Boise, I'm going to point out in a minute. But it's going to take a while, just as the lag effect, and that's the stickiness why we think CPI stays higher than the Fed and the market's expecting. Now look at Boise. It was one of the big remote work inflows of people moving to Boise. And it's the first metro area in Zillow's Home Value Index, which is a little more current, to see a year-over-year price decline. So if Boise were this red line, we'd go all the way down to a negative 1.2%. And we think we're going to see more challenges in many housing markets around the country. Looking at housing, existing home sales, from January, we've gone from 6.5 million down to about 4.8 million. Huge decline there. Makes up about 80% of the market existing home sales. Comparing the luxury to the non-luxury on a year-over-year basis on sales, you see the red line of luxury is down 28%. This is about a month and a half old data. It's probably more than that now. And non-luxury minus 19.5. Fortune had this article the other day, just looking at the 60 cities that they follow, and just the stunning downfall in the chart of prices. And you just see some of these: San Jose down 10%, I don't know what Redondo's done. Vegas, where I live, is down about 8% from the high a few months ago. Used vehicles are falling at their fastest rate ever. Used cars and trucks make up about 3% of the CPI index, but they were punching above their weight about 8 months ago. You just see, this is the index, not their cost, but just an index of the used car prices just skyrocketing. It's still well above COVID levels, pre-COVID levels, but my middle chart is the year-over-year price decline. And so we were spiking up 50-ish% 8 to 15 months ago, and now it's on a negative, down 10.4% year over year. So that's very helpful for consumers. The job market. Chair Powell said the other day at the press conference after the FOMC meeting that we have a robust job market, and we have all of this year. We actually just got October's numbers last Friday and was up 261,000. And so that's why we technically don't think we're in a recession, just because the job market's been so good. You have job losses in a recession. We think that might be the case next year, but not this year. But you do see we're slowing, and we did have the lowest print of the year for October we got last week.
Rick,
Yes.
since you're talking about whether or not we think we're in a recession, I'd just like to bring up the conversation we had because, so Rick gave us this presentation, we've seen it, and I was talking about how do you know if you're in a recession or not, because there's a definition of 2 quarters of negative growth, right? Well, that's already happened. So why aren't we in a recession? And then Rick explained why. So can you explain why, what the definition of a recession really is and who decides it, Rick?
Yes, the National Bureau of Economic Research is a group of about 100 economists from private sector and academics that have 6 primary indicators: wages, labor market, other components I'm not remembering right now, but only half of them are on a rate of change declining. And so that's why with this robust of a job market, that's why we don't think that they usually are behind about a year when they finally date recessions. They go, hey, we had a recession started a year ago. So we don't know if we were in one earlier this year, maybe we were, but just looking at their main indicators, and they don't give you for sure the secret sauce, but just looking at them, it does not seem like we're in their technical recession of the group that dates it.
So Rick, do they meet and vote on it or something? And if the majority wins to decide if it's a recession or not? Or how does that work?
I think it is a majority, Steve, when I've read on their website, if I'm recalling it right. And they do have meetings periodically. I think it's quarterly-ish that they get together to discuss what's going on with our economy.
They don't typically call it a recession until after the fact, and they look back at the.
Right. Yeah, you can be in it and they haven't defined.
Typically about a year. Yeah, about a year later. So, oh, we had a recession. Yeah. Now, the COVID recession, they dated that because we had such a sharp decline in March and April of 2020. So they dated that one quickly. So, but then it was the shortest recession in U.S. history, 2 months. So. Stock market, we of course don't invest in the stock market for the portfolio, but it does, stocks going down, it has a wealth effect. We don't spend as much when we look at our 401k statements and they've gone down. And that's a good correlation to that in consumer confidence. So what I've done here is I've created the Warren Buffett indicator of how he looks at valuations in the overall economy. So he takes the total stock market cap, the Russell 3000, it's about 97% of the U.S. stock market's capitalization, which is around 40-ish trillion in round numbers. Then we divide that by nominal GDP, round numbers about 20 million. So we'll get about a 2 ratio right now. Well, so we see it peaked at 2.2 times. So that's the value of the stock market being discounted by the value, how fast the economy is growing. So we see we peaked well above the dot-com bubble and the housing bubble. And you see what the S&P did in both of those times, down 50% and down 56%. And I have a slide on this, but let me tell you, back in the dot-com, the Fed stopped raising rates and started cutting rates. Stocks still went down about another 25%. And that happened same with the housing, the Great Recession as well. So when people talk about a pivot, hey, the Fed's going to stop, and we got that reaction today in the stock market, I'd be careful. That could be a bear market rally or it could not be. But Chairman Powell last week, he was quite hawkish that he wants not to be considered the one that let inflation get away and wants to be Chairman Volcker back in the 80s and brings inflation back to 2%. So that's why we're cautious and thinking he's going to be aggressive. Yes.
Rick, with the latest inflation report, we had 75 basis points this month, and it seemed like before the latest inflation report, the Fed was kicking around the idea of maybe slowing their rate increases. Some of the Fed presidents made remarks on the record about it, not Powell, but some of the other Fed presidents. So with the latest inflation report and it coming down, and Powell's principal battle with inflation being raising rates, it's still the prevailing wisdom, your thought that they will continue to be hawkish and until inflation reaches X level? Or do you have something like that in mind, that they'll continue to be hawkish until, or it's an unknown in your estimation?
So let me actually just skip ahead and I'll come back to the dollar. This is what this chart is right here. And so we started the year at 25 basis points. And again, we're expecting the market and the Fed to raise 2 times this year. And they're most likely going to go to 5%. Now I did this last week. And so after CPI today, these future rate hikes got ratcheted down by just one less rate hike. So as you said, we did 25, 50, and then 4 75s in a row. And the Fed and the market, he hinted that, yes, we're going to slow the pace down. Now, these rate hikes are just enormous historically. We usually get 25 basis points a meeting. And so to go down to 50, yes, that's slowing, but that's still a double hike. Yeah. And so this is about an 80% probability still, even after today's number. It dropped down from about a 95% probability. Now, what changed, though, is February now is only a 25 basis point hike. But still, March of next year is another 25 basis point hike. So it gets us still up to 5%. We think that inflation won't get down far enough. We're in the 4s and not the 2.9-ish range. That's why we think the Fed stays higher for longer, similar to what they did back in right before the Great Recession started. Similar to this cycle, they started at 1% and got to 5.25%, and then they kept rates steady for 15 months. And just to give you a stat, since 1984, once the Fed stopped hiking, on average, they cut 7 months later. And so now the market's actually pricing in 3 cuts late next year and 2 the next year. We don't think inflation is going to come down that fast. And so that's why we think Powell and the crew will be a little more hawkish than the market. I don't know if they actually have an absolute level. They're just looking at the rate of change, and they want to get it closer to 2% before they actually start cutting rates.
Part of the reason why I asked about stagflation, if you've got continuing increases in interest rates and then the unemployment rate starts ticking up, nobody wants to fall into that really difficult riddle to solve.
Yeah.
Okay, thank you.
I mean, and just to give you another side note, why didn't the Fed start hiking rates last year? We had 7% inflation last fall. Why didn't they start reducing their balance sheet, quantitative tightening, and increasing interest rates? Well, I'll take you back to the Fed chair, Powell. He's probably worth $100 million or more. He was a private equity guy. I don't know why he wants to do this, but anyway, he was not getting appointed by President Biden, being a Republican. They were floating Lionel Brainerd, who has actually got appointed as the vice chair right now, Democrat, more dovish, to be the Fed chair. So could there have been politics impacting Fed Powell not wanting to raise rates sooner than March of this year? I don't know. We'll never know. But that could be partly the case. And so that's why I think he wants to get the genie inflation back in the bottle. And I think that's why last week he said he's going to be aggressive and most likely put us into recession.
You recall that Powell and a lot of other economists were talking about transitory inflation last year, and they some of them didn't realize until this year that it wasn't transitory. It was more serious.
yeah, again, they didn't hike until March of this year. I mean, we were 4 times above their 2% target when they started hiking. Well, 3.5. So yeah. Now, kind of to be a little bit fair too, they kept interest rates at 0% for 7 years after the Great Recession, and we averaged less than 2% inflation over the last decade before this last year. So the Fed said, we put all the stimulus out there, we kept rates low, why can't we get inflation higher? Well, you kick $5 trillion out, that doesn't leave a mark on the economy. And then to be fair, also Russia-Ukraine did enhance inflation earlier this year, and we're still having that impact. So the dollar's rise is disinflationary. Our strong dollar helps us buy imports at a cheaper rate. And so that will help bring our inflation down. What I'm graphing here is the UK pound and the euro. And so the euro hit parity. It bounced a little bit today on our CPI number. But I mean, we've gone down 20% in the last year and a half, and same with the pound. And so much global transactions are done in the dollar. The strong dollar, fortunate to say, is wreaking havoc across pretty much every country. So the Fed says, hey, we're the central bank of the United States, not the world. We're going to get our inflation down. That means our dollar is going to be stronger because our interest rates have been higher. That's really what drives currencies, that interest rate differential. And so, good for us, but challenging for the rest of the world. Got that one. Now,
Rick, back on that chart
yes.
you were just on. That one.
Yes.
No, not that one, the other one.
This one?
That one. I was just going to say, it would probably be helpful to see on this same chart the interest rates. And so therefore, or CPI rather, therefore showing how the changes in the Fed rate trickle through to inflation.
And that's exactly what this chart is right here. Great lead.
Beautiful.
So I have the blue of Fed funds and the red of CPI. And you just see their correlation. And the one thing I want to bring out here is the Fed, all these cycles going back to the 60s, the blue line is always above, the Fed funds is always above CPI at the peak of Fed funds when the Fed stops their hiking cycle. And then you see we go into recession because they hike too much and generally put us in recession. Except 1995, Greenspan recognized that. He cut rates in later 95 and we had a soft landing. Well, all these other ones, we've had a recession. And so people have said, well, is the Fed going to does it want to get restrictive enough that it gets Fed funds above CPI this time? And this is what I'm showing all these cycles down here. So let me just highlight the first one, 58 to 60. The peak was 575. CPI was approximately 3.4 when they stopped. So the real Fed funds rate, so Fed funds subtracting inflation, all positive, you can see, except right now, and we had inflation bump up a little bit today, or sorry, come down. So we're at 3.7% differential, but still inflation, that is much above Fed funds. So we'll probably get Fed funds to 5 to 5.5 this cycle, and that will be probably by February. We don't think inflation will be lower than 5 by February later in the year. So this cycle is going to break its trend, but we do see disinflation, inflation coming down to 4-ish to maybe 3-ish next year. But the Fed's staying high. You just see a lot of times they'll stay high. This is what I said before the Great Recession. This is 15 months here in 2005 to 6 that they kept the Fed funds high to bring inflation down. So that it's a good correlation, and thanks for asking that question. So here's what rates have done this last year. So the dashed line, that's our Fed funds. The 3-month Treasury bill, the short-term rates, as you mentioned earlier, like 0.1 on the checking account and really low on LAIF and other short-term investments, 4 basis points. Well, that's really correlated to Fed funds. Now the others, you just see the different 2-year, 3-34, 107 to the 5-year, 158. They've all gone up. But now we have this conversion of yields. And usually when the yield curve gets congested and inverts, it's not a good sign for what's ahead. We think we're probably getting close to peak of longer term rates because Longer-term rates, 5 years and out, they're more correlated to what future growth and inflation will be. Both of those are supposed to come down. Short-term rates are correlated with the Fed, so we'll be surprised if the 3-month and the 2-year don't get close to 5%. And so the Fed's favorite yield curve metric, the 10-year minus the 3-month, has inverted. You just think typically if I'm investing for 3 months, I don't take a lot of risk. If I'm investing for 10 years on the Treasury, I have what's going to happen with inflation. There's no credit risk, but what's going to happen with inflation? So you demand more. So when the yield curve inverts, there's something wrong. That means longer term investors want to lock in that rate because they think the Fed's eventually going to cut short-term rates. So we see the dark line. Just earlier this year, the 10-year had a much higher yield, about 230 basis points over the 3-year, and it's just crashed down and it actually inverted, and it's remained inverted. And the 10-year, 2-year, which a lot of people you hear in the media and the market talk about a lot too, that's been inverted since July. So I went back to 1969. We have daily data on Bloomberg. That's why I can go back that far. Once the 10-year, 3-month inverts for at least 5 consecutive days, because we want a solid signal, not just a quick flash, when is the next recession? And this is the far right. On average, it's 337 days. So a little less than a year. We just had 5 consecutive days, and then it did bounce up, and now we're inverted again, but we did trigger our signal. So that's another reason, just if this holds true, why we think we'll have a recession next year as well. It's just an excellent predictive signal. And then, so what's ahead? It really depends on what inflation is going to do. I'm graphing Fed funds here. Again, I started back in 1989 at the city of Las Vegas, 8-9% interest rates back then. And we had the big crash down to 3%. Huge rate rise in 1994. That was the Orange County bankruptcy time with their unprudent investment decisions. And then we got down to 1% in 2004. And I thought, oh, this will be the lowest in my career. and we went back up to 5.25, and then the Great Recession hit. And then, of course, we got going up again. But the economy was slowing in 2019, even before COVID, and then pushing down. So it's been challenging the last 10 of 13 years. We've had Fed funds below 1% in this last 13 years, 10 of them. So challenging for the investment. So again, as Steve was reiterating earlier so nicely, we're so excited to have interest rates higher. We don't care about these unrealized losses. We get to reinvest at higher rates. So much better for the city's budget. And lastly, it's tough making predictions. Sorry, let me get Yogi Berra's quote. It's tough making predictions, especially about the future. So Bloomberg has a lot of forecasts. I'm highlighting the 2-year Treasury. So they give this every month, but I just go, here's December of last year. What's it going to be 12 months later, the December? And so it's been pretty accurate. We were 97 basis points off back in 2011 because what I'm graphing is the forecast versus the actual in the 2-year. The market thought, hey, we're going to have a mild recession. It's going to get back normal cycle. Well, the Great Recession lasted a long time. And so the Fed just telegraphed very well, kept rates low, starting to move them up. And then we got to 2000, and you just see the differential. The forecast is pretty accurate for about 7 years. And then 2018 hit, the Fed hiked rates 4 times that year, 4 25 basis point hikes. The Fed said, hey, we're going to plan to hike 3 more times in 19. But even more than that, the best and the brightest, JP Morgan considered the best bank, Goldman Sachs the best investment bank, they said 4 hikes in 19. Well, the economy slowed down and the Fed cut rates in 3 times in 19. So people would have said, you should shorten your duration. Looks like the Fed's going to continue to hike rates. Let's have a shorter average weighted maturity in the portfolio. Well, that would have cost the city a lot of money. That's why we just don't time these things with a large portion of the portfolio. Now, this year has been just the most abnormal one in bond market history because we came from such a low level. So the prediction earlier, or December last year, December 31st, was 1.12% for the 2-year. Well, it was 470 last week when I did. It's about 440 today. So a huge move, just not a good expectation.
Rick, a question while you're on that page. Let's assume that your assumptions on page 1 are correct. What does that say about our investment policies? Should we be doing anything any different? What does that mean for our portfolio?
So it means that we're going to earn a higher rate of income. And so let me just, Nilesh had this out. So we have 37% of the portfolio maturing over the next year. We'll get to reinvest that, most likely all of it, at much higher rates. A lot of those bonds are yielding under 1% that we bought the last few years. So that's just a substantial increase. So we don't want to change our policy and strategy, I should say. We just want to continue to ladder the portfolio out. We might do a little bit of a barbell, as you see here, because short rates are going up, and then we want to have a little bit longer out in the 5-year sector to lock that in a little bit longer, but not too much of a strategy change. Although there is one strategy I'm going to get to in just a minute about corporate bonds, because you guys asked that earlier, and about commercial paper. Now, you see the yield. We talk about safety and liquidity, 1 and 1A, always the objectives. But, hey, people, what's the yields you're doing? Now, just comparative, and no one has the exact same cash flow, but California cities and counties have very repeatable cash flow patterns. And so you guys are in LA County. We have a way different strategy than LA County. They keep things so short, just over the long run, they just have underperformed what the city has earned. And that portfolio is like $40 billion. So it's just a massive amount of interest income that they could have earned by having a little bit longer duration. So for example, this low earlier this year, we were about 140. The county's yield was about 70 basis points, so half the yield. Now they're going to react a little faster, but again, if we go into recession in a year or so from now, the Fed cuts, that's where we have our longer duration, longer weighted average maturity. We'll just do better over the long run. Unless rates just skyrocket like they did in the 70s and 80s, which not a lot of people think that. It could happen, but it's a low probability. Nilesh showed this slide. It's just incredible, the growth of the portfolio. A little under 50 million, now more than double that. And we see the cyclicality. Now, during COVID, Steve did talk about that the city was spending more money than it was taking in. Revenue wasn't as high during COVID. And then you guys were prepaying pensions as well. That's some of these big downdrafts. And so instead of paying it every payroll, it's paid once a year. But then the economy recovered, stimulus money came into municipalities. So all of our clients look like this, pretty much at all-time highs. And so we'll see this probably trickle down because stimulus money will be spent, the economy will slow, tax revenues won't be as strong. And so your expenses of the city have gone up, as Steve mentioned, with inflation. So we'll be surprised that the portfolio's overall value doesn't come back down a bit. Now, talking about income, I want to double check Nilesh's figures earlier because, but I remember I was going to tell you what caused that big jump in income this quarter last year is, you might remember we had a Philip Morris bond in the portfolio, and the mayor wanted us, just from a policy standpoint, to sell that. We liquidated that at a large gain. I think it was about $121,000 gain in that quarter, in that month. So it really shot up interest earnings a year ago this quarter because of that decision that the council made. So
There you go.
yeah. So you do see that we have increased earnings from last year to date, 382 versus 425. We will continue to see this accelerate as we get to reinvest maturities. And as Steve mentioned, property taxes coming in next month, we'll get to invest that with 4% yield versus 0.4% yield a year ago. And just looking at the benchmark, this is looking at the yield of the portfolio versus the 0 to 5 year treasury, which just is a good benchmark because that's what we can invest in, 0 to 5 years of the portfolio. You just see with our strategies, we have some corporate bonds, some agency bonds that gives us a little advantage over a treasury index, but just keeping the duration a little longer over the long run has provided that yield advantage to the city, as to the index versus just other entities like the county that holds it shorter. Now, total rate of return, this is when we do the mark to market. And this is just really good. People go, wow, the portfolio has lost so much money. What are you guys doing? Well, the market's actually lost more. This light blue is the benchmark of the 0 to 5 treasury. And you can see over the year, it lost 532 basis points. And that's just because bond prices and interest rates are inversely related. So we don't have to recognize any of that. We'll hold the maturity and that'll come back. And I love the comments earlier. People thought, hey, you're doing such a great job. You have these unrealized gains on the portfolio, and go, well, yeah, because interest rates dropped to nothing. And so we have to reinvest at 10 basis points. That's not fun. It's so much better to have unrealized losses not to realize those, and we get to reinvest at these higher rates. So we include this total rate of return in the portfolio so you can see if we liquidated, this is what would have happened. So that's why we don't do this on gains or losses. I thought I had let me bring up another slide really fast. I thought I put this in there. Let me answer this question. I thought I had it here. We'll just bring up this month. Do you see this report for October?
Yes.
Okay, let me just show you the strategy. Okay, so this is our sector strategy. And so the corporate bonds is the purple line. And you can see we were at 20-ish% last year. Now, we thought we might have an economic slowdown or recession. And what typically happens then is corporate bond yields, as compared to treasuries, their spread, they widen. And so we had maturities roll off. We didn't reinvest in corporate bonds, and we kept those maturities short. And so we think that the spreads have widened a lot, actually. And so we'll probably start buying more corporate bonds with high quality companies like a Costco or a Toyota over the next year and increase this allocation, because we'll get such a better spread differential.
What is
Again,
that
about
spread?
a year ago.
What is that spread
Go
to
ahead.
treasuries now?
So in the 0 to 5 year sector, the A to AAA that we invest in, so about a year ago, it was about 30 basis points. Now it's about 100. So it's gone up by triple. And so that's where we're looking to invest in some of those bonds here over the next 6 months. So you'll probably see this purple line start to climb up as we feel confident about those companies having a lot of money on their balance sheets and doing okay. And so we think spreads have probably peaked out, the yield differential, I mean, and so that's what we'll take advantage. So that's the biggest strategy change, just from an allocation standpoint, we'll do to be able to enhance the income of the portfolio. With that, that was my last slide. Any other questions?
Just back to that last slide, is there any, right now we can allocate, I believe it was 25% to commercial paper and money market funds, and right now we have 0 in those, and we're going more for CDs. Is there any thought about shifting to money market funds and commercial paper as opposed to CDs to get a higher yield on the liquid side of the short-term assets?
Yes. As Steve mentioned earlier, LAIF is a longer duration liquidity portfolio the state runs. And so it's only yielding about 1.95% today. And money market funds are in CP around 3.5 to 3.6%. So we're going to be realigning that over the next month. They're opening up a money market account with the custodian, and then we'll be able to shift money in there. So we're absolutely doing that with that big change in LAIF versus how fast the Feds move. We're going to take advantage of that. Okay. We've done that with all of our clients. We've lowered their balances down to like 100,000 in LAIF, and just to put it in money market funds and CP.
Okay.
So good question. Thanks.
Rick, on a logistical question on sector allocations. So for example, we've got in corporates, continuing that trend, got 1, 2, 3, 4 maturing in 2023. So how far out of these maturities do you circle back with the city and say, all right, we've got, in the second quarter, we've got 3 corporate bonds maturing. We'd like to go ahead and reallocate that funding to, and you make a suggestion on the security you think would be best suited. Do you do that on an annual basis with us, on a quarterly basis with us?
We're looking every day. I mean, we could have a treasury maturing next month, and we could look at going into a corporate. So, or property tax is coming in, new cash, we might look to a corporate. And we'll probably look in this 3 to 5 year sector to buy corporates, just to lock in those yields. And they have a little wider spread than the shorter, like a 1 year corporate versus treasuries or agencies.
But maybe I'll put it a different way. For a planning session with the city, over the course of the next 12 months, we have these securities maturing and have a planning session to say, with those maturities, we plan on doing X. Or is it more on a day-to-day
No,
basis,
we
like you're
don't do
saying?
that. When they mature, we look at what's available. We can't time the market 12 months out, 6 months out, or anything like that.
I'm not talking about timing the market. I'm just talking about having a reminder as to when those things mature and then having it triggered and say, okay, we need to go ahead and make a decision now.
We do that monthly. We're looking at every month, we're looking at the
Okay. So then that's the
portfolio.
answer to the
But it's
question,
really
is monthly.
when the things mature. I mean, we know something's maturing, and so Rick's already looking, he's scanning the market, not just for us, but for all of his clients.
Sure.
So he knows what's out there. So it's not, the first thing that fails in a plan is the plan. So if you plan 6 months out, what you think might be available might not, because that really is trying to time the market. So what we do is when the securities mature, Rick is already looking out there and saying, this is a good investment, let's do it. We're not going to put the money aside and wait 6 months to reinvest it either.
I think you're misstating what I'm asking. So I'll use a bromide to say failing to plan is planning to fail. So if you don't have reminders set up as to when maturities are coming due and have a monthly meeting, a quarterly meeting, or some kind of meeting scheduled to discuss those, you're planning to fail or you're scrambling at the last moment. That's what I'm asking, is what the planning
No, that's not what
strategy
we're
is.
doing at all. That's not even close. No, we meet regularly. When these things mature, we're ready to reinvest. And that's what Rick does on a full-time basis for all of his clients.
I'm not saying that's not what Rick does. I'm asking how we are communicating with Rick along those lines. And you said that
Communicate
is
on the telephone and by email, and we get these reports. We look at them monthly, we look at them weekly,
not literally communicating, but you just said it, it's monthly.
at a minimum.
But
Okay, then that's the answer.
Let me just
Thanks.
add to
At
that.
a
We know the
maximum.
maturity. I mean, let me add to that, because we look at the maturity, we look at the portfolio every day. And so I know when things are coming up, and like a week out, I'll say, email Stephen Nilesh and go, hey, this bond's maturing, or you are getting property taxes in. This is what we're thinking. So it's driven by the cash flow. So it's just when that money's coming in or maturing. So we're constantly looking at that and interacting with Stephen Nilesh to give them the idea to get their approval before we buy.
Okay, thanks, Rick.
And the
But
structure
going
of
back to your
that,
other question,
the structure of that is really part of the investment policy as well.
yeah. But let me just go back to your question a little bit too. Like I mentioned, over the next 6 to 12, well, probably 3 to 12 months, maybe even next week, we're going to look to increase that corporate bond allocation. It had trended down from 20 we did do good timing on that with spreads compressing and now widening substantially from about 30 to 100 basis points. I'll be surprised if we don't have at least double the amount of corporate bonds a year from now, just because of that market dynamic. That is our plan, just because of what's happened when these maturities and new monies come in.
That's great. Thanks, Rick.
Yeah, no, excellent question. Thank you. Anything else?
Rick, how many times have you given this or a similar presentation in the last 4 weeks?
Well, we have 40 clients, so probably 20 of them over this last few weeks. And
Okay.
a lot of boards and city councils, why do we have these losses? What's going on? And, again, going back to, we love this. We are so excited to reinvest your money at much higher rates, triple your income over this next year or so, double, triple, depending on the portfolio.
And so that's my point. So your excitement shows. So he's given this presentation, 20 times, he just said recently. And you sound upbeat when you're giving it. You don't sound bored like, geez, I've said this 20 times already and I'm saying it again. I mean, you really do literally sound excited about it. So.
It's been challenging the last 10 of 13 years to have yields below 1%. So this is wonderful. This is when I started my career at 9% yields. We're not quite that high, but this is substantially better. And it just helps the budgeting process for our clients. I mean, you get to spend more. This is awesome.
Yeah, I think all fixed income managers are happier these days.
Yes, indeed. All right, I will stop sharing and get back to that.
Any other questions or?
Steve, I appreciate that this conversation is primarily looking at the revenue and the investment side, but we're going to be asked at some point in the very near future about what do we do with all the excess funds? How does the city spend that? Can you or Rick give us any insight into what you think is going to happen to inflation and how that's going to affect the decisions that the city is going to make in terms of their expenditures?
It's not my role. It was when I was on the city council, when I had to look at the budget and do spending plans. Really, what we'll be doing is when we look at the mid-year is readjusting our budgeted interest income to give the city a more accurate picture of what they'll have to spend in terms of revenue from the portfolio. But in terms of advising the city on how to spend the money, if they ask, I could give them my best answers from my experience, but I'm not on the spending side.
I'm not looking for advice on the expenditure side, but to your point, theoretically, there are going to be excess funds that are going to be available to the city for the balance of the year. Can anyone give us a macro kind of a picture of what the city might expect in terms of inflation and how that might impact the expenditures over the year?
If there are excess funds that are available for investing, we would, and we will, invest those funds for an appropriate term until cash flow needs dictate that those funds be maturing. So to that end, we would be maximizing any revenue we can from the investment portfolio if there are excess funds available.
But you can't, on a macro basis, you can't give us a clue that the costs of projects over the next 12, 18, 24 months might accelerate at some rate.
No, I'm not. That's on the spending side. Cost of projects is spending. We don't do that.
I think if you look at the inflation forecast that Rick went over, they're forecasting going from roughly 7-8% inflation down to 4% inflation by the end of 2023.
Right.
So I think that's a partial answer to your question. If the city is, but that doesn't mean the prices are coming down. It simply means they're increasing at a slower rate.
Right.
So I would think if I'm the city thinking about a project, I wouldn't wait based on inflation, because inflation is, we're not going to enter a deflationary period.
Right.
So I think that answers your question. Inflation over the next 2 years, based on these guys' forecast, is still going to be at the lowest in the 4% range.
Right.
I think having the city manager here would have been helpful as well to tie to it, both to your point and Mr. Castle's point earlier. Like, what are we even seeing in terms of inflation real time? Projects that were budgeted at a certain level, that materials or labor, other things are kind of exceeding that. Like, I get your point that that's not your purview.
Yeah, it's not our purview. I mean, we soften that by increasing income from our investments, but relative to the amount of spending, it's probably not great relief. We did go through a period, some years back where costs were low, interest rates were low altogether, and we didn't do projects.
Yeah.
So now we're looking at, we've got crumbling infrastructure on the waterfront, and that's going to be enormously expensive at this time going forward to get those things done. Enormously expensive, and I did at the time say we should do this now. This is a rare opportunity. We should get it done, but it didn't get done. So.
Okay. And Steve, if I can add, if you're, like Steve said, we're not on the budgeting side and the expense side, but I talked to a lot of budget officers, and I would think the city is very similar, where the largest expense for the city is personnel, wages. Is that correct?
It's almost 70 or more %.
Yeah. So, I mean, that's your inflation driver right there. You're going to have projects here and there that certainly add up, and it's higher cost to build them. But what is your benefits and salary cost doing? That's really going to drive your expense side.
Yeah, we've got MOUs out with our chief principal expense there, which is public safety, over the course of the next, at least I think it's 18 months. We also refinanced our pension debt to try and forestall that increasing number. So we've taken some steps to go ahead and mitigate any increases in personnel over the course of the next, say, 12 to 18 months.
Good to hear.
Any additional comments or questions?
Public
Any,
comment?
any questions from the public or e-comments? Since there's no one here.
There's no questions on Zoom or e-comments.
All right, can I get a motion to receive and file?
Motion to receive and file J1. And thank you, Rick. And thank you, Steve and Nilesh.
Thank you.
My pleasure. Thanks, guys. Bye.
Rick, are you going to hang on a bit? Or are we going to talk about the investment?
Vote on that next.
Sorry, yes, I forgot. We had no change. Yes, I'm here.
Doug, can we do a roll call vote?
Sure, we can do a roll call vote to receive and file J1. Commissioner Conroy,
Aye.
Commissioner Jesty,
Aye.
Commissioner Castle,
Aye.
Commissioner Woodham,
Aye.
Chair Marin,
Aye.
Commissioner Samples,
Aye.
Commissioner Solomon.
Aye.
All right, item J2, annual review of the city's statement of investment policy 2022.
Okay, this is going to be an easy one. Last year, we did mail all of you, except now, somebody new. I don't have a copy of this, do you?
I believe I did get a copy of it from Doug.
Oh, good. With this, okay, good. All right, so this is the first time in my career, I think, we're recommending no changes. And that concludes my report. So, but anyway, we're here to discuss it. You know, it's important for us to be presenting it to you. It's important for you to be aware of what the investment policy is. We do review the investment policy quarterly with you. And if we have any recommended changes, we go over those with you. But we have none this time. But if you have questions about the policy, Rick is here to answer them. He's seen more policies than I have. So, and like I said, it's something that I kind of have taken for granted. But I did some minor consulting with a neighboring city, and they don't even have one. So it's a best practice, and we are doing it.
What were the factors that led to your decision to make no changes at this time?
Mostly the lack of legislation requiring changes. And then we already did a bunch of the punctuation and formatting changes already, so.
Steve, couple of questions. First, this doesn't particularly relate to the IPS, but just a curious question. Who's our custodian and how much are we paying custodian?
Our custodian is US Bank, and that changed because it used to be Wells Fargo. And I don't know off the top of my head how much we pay them.
It fluctuates. I don't know the exact number.
Yeah, I don't know the answer to that off the top of my head.
Okay. And then question on page 19, there's a comment on the list of qualified brokers. And it references the fact that that list is kept. I think if we're publishing this on an annual basis, it would be useful, I think, to list those qualified brokers every 12 months or so, just so we get an idea of who they are. That's on page 19, I think. Yeah, Exhibit A. We show who the registered investment advisor is, and then qualified brokers. FHN maintains an approved list of qualified broker dealers.
Yeah, that's interesting. Rick, do you have a list that we can, I don't know if we need to add it to this or at least show people what it is?
Yes, and we changed that language a few years ago since we have to follow all the SEC's guidelines to monitor our broker dealers, but we absolutely can send a list. It's about 35 broker dealers that we work with. I'll just put a tickler file for our compliance folks to send that to you on an annual basis. And so you can have that for a meeting.
Okay,
I'll get it sent over next week. So,
thank you.
And then last question, and this is kind of nitpicky, but go back to Exhibit C, Investment Procedures Manual. Items 2, 3, and 5 all had the same heading. On behalf of the treasurer, the financial advisor will perform the following duties. Let me suggest, it's just confusing that it says the same thing, but when you read the details, they relate to different things. I think item 2 relates to security selection, item 3 to selling securities, and item 5 to reporting. I'd suggest that you work those titles into the heading for that section so that someone reading this, it makes a little more sense to them instead of all 3 headings being exactly the same.
Okay, I'm looking for that. Do you have a page number for me?
Is it the last?
Do you follow me?
Oh, here we go. Okay, thanks.
Exhibit C.
Exhibit C. At the last page in the,
Yeah,
for instance, item 2 again says, on behalf of the treasurer, the financial advisor will perform the following duties. Says exactly the same thing on 3 and exactly the same thing on 5. I'd just say, add parenthetically, on behalf of the treasurer, the financial advisor will perform the following duties relative to security selection on 2.
yeah, that's
Relative
reasonable.
to selling securities or relative to reporting, just so that, again, the average person reading this, then it's a little easier to understand it.
Well, I would like to comment that I'm congratulating you for the first person that's ever made a comment on the investment procedures manual. And when I began doing this job, I had to go looking for it because it was required in the policy and I didn't even know what it was. So I had to go find it. We created a new one and here it is. And now it's part of, we present it as part of the policy so you can actually see it. And it's required in the policy. So I appreciate that you looked at it and I appreciate your comments and I think they're worthy and yes, we'll update that to reflect your concern.
Steve, on Investment Procedures Manual, the Statement of Investment Policy, item 7, page 1, it states, city treasurer will send monthly investment reports to mayor and city council, city manager, city clerk, and director of financial services. Since these reports are being generated, would it be possible to include those reports, those monthly reports as part of our monthly meetings?
I mean, we could, but I wouldn't recommend it because, we're required to give you the quarterly report and that's what we do. And we follow this procedure and we send this out to the mayor and council every month.
Why would you not recommend it then?
Because it's not, we're already giving you, that would be a change in the actual required workload of the, within the policy itself. And I mean, we send this to the board, the elected board, and that's how we do it. So
What's the length of that report? The report you send that Mel just meant, or that
it's similar to
Eugene
the
just
quarterly
mentioned.
report, actually. We get
So
one every month.
it's a long report then.
Yeah.
So if you're sending, I guess, what would be the additional work in terms of just even forwarding to the commission?
Yeah, I don't think it's a tremendous amount of work. It's just that I like the way it works now, and I like giving you the quarterly report. And we're obligated to be here to do that. So
No, I mean, I think-
it's public record. I guess we could post it and you could look at it like the regular public. It's maybe something we could do.
Could we do something like that and we would just bring it ourselves?
Yeah, that's true too. Yeah.
So would that be posted maybe on the city website under the financial services department? If it was,
I
if
don't,
it was able
well,
to
we
be done?
don't post it, but it because we send it to the city council, it becomes a public record.
we'd have to make a public records request every month, each one of us. in
Yeah,
order to
that
do
wouldn't be necessary. I don't know, I'll look at it, but it's not something I'm recommending doing, but it's something we could do, but.
Is there a way that we could just receive that as a commission, as correspondence to the commission, rather than having a presentation?
Oh, yeah, we're not asking for a presentation.
Yeah, just the email, just the document.
Yeah, it's, I'll take it under advisement and see what the workload is and what the consequences are.
The idea of putting it on file and then letting us, if we want to go in and take a look at it, we can, has a lot of attraction.
Yeah, that to
You
me
don't
is,
mail it, you just put it on the computer. put
that
it
to me
on-
is the point of it. Not that we have an agenda item for it, but it's included as part of our monthly documents like a blue folder or something.
Like a
that's
blue folder
available.
correspondence?
It may help us have more meaningful questions come the time of the quarterly report too, if we've seen some monthly
Yeah.
activity leading up to it.
It's reasonable.
Okay, thank you.
Any other further questions or comments?
Just related to this last request, so what happens to that? Because it's not going to be an agendized item to follow up, hey, what's the status on that? Maybe, you said you're going to take it under advisement.
Yeah, I'll look at the request and see about how we can post it, or maybe it's easy enough to send to you, maybe it's easier to make it available to the entire public. So,
Sure.
yeah.
So could maybe let Doug know so that he can report back to us at our next meeting, or what? I'm wondering, how's this communication? How are we going to close the
Make sure that
loop?
it happens. Yeah.
Yeah.
I'll have an answer by the next meeting on how I would go about it.
Okay. But I don't expect you at our next meeting. You'll let Doug or somebody know, or
Or you
how
mean next
are we going to
quarter?
get the info? Yeah.
I don't know yet. I'll send you an email as a group, I suppose. I could do that.
Great.
Okay, thanks.
Yeah, because one of our duties is to maintain continuous study of sources and so this would just be valuable to us. And if it's just a communication without a presentation, that would be continuous. So I do have one other question on item 17 of the investment policy, item D. This has been a subject of conversation in the past. Item D is competitive bidding, and it talks about, and Rick, no slam against FHN, you guys are doing a great job. I'm just questioning the policy, because the policy says that on an annual basis, our treasurer's office is supposed to be soliciting bids for city investment transactions. Is there a desire to change that policy, or do you do that on an annual basis?
Okay, there's two ways to do investing. I've answered this question before, and I know it comes up again and again, but we can do investing in-house, or we can contract out and have it done. So we're not investing in-house. If we were investing in-house, we would be doing that. But the process of seeking competitive bids is done by Rick. And then when we provide, and we have shown you this before, we've provided the receipts of the actual trades, and you can see the comparative investments. So we have answered this question before.
Okay, well, I guess I'm a little unclear. It sounds like what you're telling me is that this item is irrelevant because we're not doing our own investments.
No,
So
it's
we
not
have to-
irrelevant. It's important to have in the policy because I'm not interested in doing, I'm personally not interested in doing trading in-house. We used to do that. It was very expensive to do, and you had very limited, a very limited view of the market, as opposed to having a professional like Rick, and there are other firms that do it for us. However, because it is possible that somebody might prefer to do that, it should continue to be in the policy. So it's not irrelevant. It's just not something that applies to the way we're doing our investing. The way I think you're perceiving that requirement should be followed. So Rick is following it, and you are getting competitive bids on, the city is getting competitive bids on every investment.
Okay.
So What I'm hearing is that the competitive bidding section of this doesn't relate to hiring the financial services provider like Rick. We've hired Rick to essentially do the competitive bidding on the broker dealers. And what Steve's shown us in the past is that we are getting those, we're doing the competitive bidding and getting the good pricing through those broker dealers. But to that extent, how often should we, this says annually, so it seems to me that once a year, Rick should continue to provide that information showing that we're still getting.
Well, we're doing it with every trade, so it's happening more frequently than once a year. So every trade, we're getting competitive bids.
Okay, meaning that we're purchasing the financial instruments at the best price,
Yes.
right? Okay. And our broker dealers are just making a spread on it? Is that the limit, or maybe this question's for Rick? Is there additional compensation or any other incentives for any of the broker dealers that you work with?
So that's why we go out competitively. If we see a bond we like, we go out to who possibly might own that. And then we put that out to bid to get the best price. And so they could have a bond that they've had in inventory that they bought at a higher or lower price. We don't necessarily care what they make. They don't charge a commission like when you buy a stock. Fixed income world's different. And so whatever they make on the other side, we don't care. We just are going out and getting competitive bids on the securities that we purchased, and we'll put it out. It depends on the bond. Sometimes there could be a dealer, only 2 dealers have this bond, and we really like it. But we'll go look at a comparable Costco bond if we're buying a Target bond just to see what context is, and we'll send that over to Steve and Nilesh to show them market context. Again, the fixed income world is different because Costco has all these bonds, but they don't trade. There's one stock. They don't trade as often. And one stock of Costco trades, every day millions of times. But this bond could trade once every couple months. And so the fixed income world's very different on how we go out and get those bids and buy for the city.
Okay, so I think what I'm hearing is if the city were doing this itself, the treasurer's office would have to go out to bid every time. But FHN is providing that bid information to the treasurer's office. It actually is happening. You're transferring that responsibility and you're actually monitoring.
Correct.
I guess that was kind of the big question. Is it being monitored? So, okay, fine. Thank you.
Rick, going back to compensation for a second, beyond the $18,000 or so per year that Redondo pays FHN, how do you make money managing our portfolio? How does FHN get compensated beyond that $18,000?
We don't. That's the only fee that we get paid on your portfolio. It's you guys were one of our first clients when we started our firm many years ago, and we would charge probably 5 times that to a client today with your size of portfolio. So we've kept that price very low because we've just appreciated the long-term relationship, but that's 100% of our compensation.
Okay.
You guys are getting incredible value with them. I mean, it gets political and we get accused of doing the wrong thing by hiring Rick. It's the strangest thing. And you get the best value. It's incredible what you get from this, so.
Well, I think the presentation tonight, the data that we've seen certainly supports that. I'm extremely happy with the job that FHN is doing for us.
Yeah, and it's
Thank
going to
you.
be exciting. I mean, you look at the size of the portfolio right now and the growing interest rates, and we're going to see some incredible returns in this next couple quarters. So it's exciting.
Great. Any other questions, comments? Anything from e-comments?
There's no comments, e-comments, and there's no comments on Zoom.
Move to receive and file.
Second.
I get a roll call vote?
Sure, do a roll call vote for item G2. Commissioner Conroy?
Aye.
Commissioner Jesty?
Aye.
Commissioner Castle?
Aye.
Commissioner Woodham?
Aye.
Chair Marin,
Aye.
Commissioner Samples.
Aye.
Commissioner Solomon.
Aye.
All right. Item K, member items and referrals to staff. We'll start to the left with Commissioner.
May I interject something? Rick, thank you very much. You're excused. If
Thank
you
you,
haven't
Rick. You
gone
don't have to
already.
stay.
Thank you.
Okay,
Thank you. Good to meet with you. Take care. Bye.
okay, thank you. Bye-bye.
Thank you.
Yes, thank you, Rick. Thank you, Steve and Lesh. I have no additional items for staff this time. Thank you.
Commissioner Justy. Commissioner Castle.
No.
Commissioner Woodham.
One item, we talked about having CalPERS coming next month, and Doug says that's still in the works, and we hope to have that happen. In thinking about the importance of our relationship with CalPERS, and the fact that since I've been on a commission, we've had one presentation by CalPERS. I think we should institutionalize an annual presentation by CalPERS, and I further think that we should strongly advise city council. I think all the councilmen need to be at that meeting. I can't think of anything more. I mean, we just financed a $225 million debt that we accrued over time that we might not have accrued if we had taken a closer look at CalPERS and what they were doing. Maybe not, but at least the perceived importance is so great. I can't see, if city council knows about this, I can't see any of them not coming to the meeting. So my suggestion is that we schedule that and that we somehow issue an invitation to city council, let them know what we're doing, and certainly ask them if they want to show up and come to the meeting. We'd certainly welcome them here.
I don't know the process of doing that. Currently, when I send out the agenda packets to all of you as a commission, the mayor and council also receive an agenda. So they're aware of all the items that are coming to you at these meetings. I can talk to city manager if, I really don't know the process of that.
I guess you're saying just to include a specific invitation
Yeah.
for that meeting.
Yeah.
I mean, they'll get the packet anyway, but we would like to invite them to that.
They couldn't all come and participate. That would be a city council meeting.
Oh, right.
Well, at least they could, can they dial in?
No.
They can't have a discussion by more than two of them. Otherwise, that could violate the Brown Act.
So, and realize that the CalPERS issue that we've just addressed is something that was created as a Hydra kind of a monster back 2013, 2010, in changes in the CalPERS compensation. And that's been a problem for all of the cities since about, actually, I think it was before that. It was like right around 2000 when they made a huge change in the compensation. And you've got all the cities in the state are having a similar problem to what we just addressed.
No, I'm sure they
So
are.
hopefully going forward, we won't have this again.
Well-
But I do agree that we should probably have some kind of annual meeting with CalPERS in order
Right.
to make sure we're still on
Yeah.
track.
I think this first part of that, having the annual meeting with CalPERS.
Steve, could
I
you
think
stay just for a second, please?
There's,
Would you stay just for a moment, please, before you go?
You want to speak to me after the meeting?
No, in the meeting.
I don't think there's any question that we should do that. I'm just struck by the fact, I understand the Brown Act and its purpose, but it's interesting to me that we've got a situation where there could be actual good done by having city council present.
Or should we propose that CalPERS comes to a city council meeting and presents?
I guess that's what
That'd
I'm
be the other way
saying.
around it.
I don't think we can do that for the city council.
Or just a recommendation, send a letter as a recommendation saying.
We can have them present to us, and city council can still get a copy of any presentation that they provide to us,
can
as well as viewing our
Yeah, we can
our
send
meeting.
we
Yeah, we can send the
to city
report.
council.
Yeah, along with any recommendations we have based on the presentation.
I guess that's the approach then.
No comments from me. I don't know.
But I agree, it should be a regular and recurring meeting And to the extent we can, we should start planning that or finding out when they can do that.
Sure. We reached out to them late this summer, I believe, and their list that they could come is at the next December meeting.
So they heard December.
I will confirm again that they will be coming. I'm anticipate them to be here. And maybe going forward, we can see what's best in their schedule to do an annual meeting with you, with your commission.
Yeah, their last meeting was very informative, so.
I have no additional comments. I don't know. Commissioner.
Well, I'd like to circle back to what we were talking about earlier in terms of information moving forward from the last meeting to this one, talking about possible bond issues and things. What do we do about getting some feedback, whether we can have that follow-up meeting with the city manager and the department heads and talk about those bond items and budget items that we're talking about a bond issue for?
Yes, I spoke to City Manager Mike Wazanski about our last meeting. He's aware of Cosmont being here and doing presentation. Again, it was kind of just an initial open conversation. I asked him what would be the timing moving forward. He didn't have an answer for me that it would be, it's nothing urgent. It's nothing that we're going to do in the next month or so. But you will be informed once the process is rolling.
Okay.
Remember that right now we don't have a finance director. We may not in the near future have an assistant finance director. We don't have a payroll director. So I understand and I agree with you all about these things, but respectfully, I don't know that we're going to have a really heavy schedule that way until some of the logistical issues that are going on within the finance department are addressed.
To what extent should the logistical issues within the finance department affect us as a body that represents the citizens of the city?
They shouldn't, but what I'm suggesting is that we may be slower getting things back to us than otherwise. That it shouldn't affect us and the workflow should be the same. But I think that's why perhaps we're not seeing the requests that we're making coming back to us. It was more an informative rather than to minimize the work.
Okay.
I agree that they should be coming back to us, 100%.
I mean, we're still here.
I agree.
I don't think,
Speaking reasonably.
I don't think the questions that we were asking really have a deep impact on the finance department. We were asking about things like the whether there are any funds available to cover some of the major construction projects that are in the list. What's the city's position on doing this bond financing? Items that are much more in the purview of the city manager and the department heads that would give us insight into it rather than the finance department.
I think then other than the finance department or the city manager, be if we could speak to somebody from Public Works about drilling down on what some of the costs might be to get our head around, because the numbers that were presented at the last meeting were general numbers, and maybe talking to Public Works about their processes for coming up with these numbers and then getting a better idea of what we might need to get bonded for each of these items and maybe a deeper dive. Maybe it'd be a Public Works issue.
And it's primarily probably Public Works, but the majority of the capital improvements that they were talking about were police and fire. So getting an idea of the urgency and why they're on the list and kind of the support behind that, I think would be valuable to us.
I don't disagree that we need to discuss these things. I was just trying to provide some context as to why perhaps it hasn't come back to us.
I'd like to make one comment. Eventually, a lot of that workload does come to the finance department, even though we may not be directly involved. They will come to us, and whether it's some type of payroll analysis or something like that, it always lands up in the finance department some way, somehow. So it's a collaborative effort from all departments.
Okay, understood. The other comment I would have is having Rick here virtually in other meetings, like having CalPERS present to us. I don't have a significant problem with them dialing in rather than having to be here physically. If that helps us get better information, and it makes it more convenient for the presenters.
Yeah, absolutely. They can do it via Zoom as well as in person.
That's
Has there
all I
been something on that from the city? I mean, I think it's great that Rick was able to present remotely, but we know that there's policies in place now that COVID is essentially over. For example, we're not allowed to be a part of the quorum remotely, right? So I guess my question would be, I have a lot to say for a guy that had no referrals to staff, but sorry. What is the policy, or is it still liquid and we're figuring it out?
Currently, as a commissioner, you have to be present. You can't come in remotely. If we have an advisor or someone from the outside, especially if they're out of state, they're able to come in remotely.
Okay, so out of state presenters.
Presenters that are not able to be here physically.
So again, for like a CalPERS, you kind of said that they needed 6 months before they could present to us. If we're
Yeah,
remotely got them to present earlier, that would be beneficial.
you know, well, with CalPERS, we just asked when they could do a presentation. December was their earliest available. I'm not sure if he's going to be here remotely or if he's going to be here in person. We'll leave that up to them. In some cases, if you want them to come here, they will charge you for that.
Got you. Okay.
That's a good point, though. You might make sure that you give them the option, because that would certainly make the process easier from their standpoint. And much easier to schedule on an annual basis,
Sure.
recurring time.
Yeah, whatever's easiest and makes it easier for them to present to you. And if it's a better, smooth process, we'll give them that option.
Great. Thank you.
That's all I've got.
Okay, so I've got two things, please. One is a really big thing happened here last couple of city council meetings, and as a result of the work that the Budget and Finance Commission did, the city treasurer's office did, which is we're putting on the ballot a revision of our procurement procedures and updating the numbers and updating our procurement procedures, which is going to make things a lot easier to work in the city for people like the finance department. And a lot of that wouldn't have, or that process started back when the treasurer's office came to us with the Moss Adams report, which was started back in 2015, maybe 16, wasn't, maybe not that long ago, but we got it in 2019. And it made recommendations about how we're changing our procedures, made recommendations about how we're changing our procurement. And that got forwarded from the Charter Review Committee to the City Council. And the City Council reviewed the language, and they're having ballot statements and things created for the voters in March. And it's going to be a really big deal, as I said. So I want to thank you in person for starting that process, and everybody here who participated in that Moss Adams stuff. We sit here, we do a lot of things, we have all these meetings, we talk about it, it could take years, but big things can happen, important things can happen. It starts off with the idea, the hire, moving it forward, our meetings. So I just want to say thank you to everybody here, Steve and your team for starting that, everybody here at Budget and Finance for doing that, people who weren't here, people who are here now hearing those reports, thank you very much. So thanks, Steve. The second thing was, no, that was all I wanted to say to you in the meeting. I give you leave. Hugs and kisses.
Thanks a lot.
All right, and welcome.
Thank you.
Congratulations. Thank you for your service, and everybody else, of course. Don't scare away the new guy, like you did the last guy. I think he left the state.
Ernie? Ernie left the state?
No, not Ernie. I'm talking about his
Oh.
Steve.
Well, Steve Johnson. Yeah, Steve Johnson.
Yeah.
He did.
All right, take care, everybody. Thank you.
Have a good night. Thank you.
The second thing is, as part of that discussion at Charter Review and to Commissioner Sample's discussion, we've had this discussion before, so maybe in the new year, sometime in the first quarter of 2023, to bring back the municipal code dealing with competitive bidding and the procedures that we use in order to secure professional services. We've talked about it a couple times before.
Before we go further, are we talking about the recommendations from the Moss Adams report, something that was in there, or or was it
Not
something?
from the Moss Adams
Okay.
report.
Okay.
Our municipal code section dealing with how the department heads contract for professional services is very broad. Does
Okay.
not require competitive bidding. There are a number of different things I don't want to get into. It's not an agenda item.
So we're talking about municipal code, current
Yes.
municipal code.
Correct,
Got it.
yes. As in our discussions at charter review and our discussions here, department heads have great latitude in order to go ahead and simply make a recommendation without going out to competitive bid for a vendor to come and perform a service. And it ties into something else that Commissioner Samples discussed, which was during an emergency situation, that type of thing gets amplified. So we secure somebody's services in an emergency situation like COVID or something like that, and the terms and conditions and those sorts of things kind of get hurried through because of the urgency of the situation. And maybe do we have a procedure to circle back for those contracts that we engaged in during the emergency situation to go ahead and review those contracts? How long were they for? Are they open-ended? Is it time to review them? Should we go out to competitive bid? These are all discussions that I think is worthwhile for us to have with regard to fiscal responsibility and competitive bidding for the city. And we've talked about it before, but understanding the restraints, and I would really prefer that we have some of the other requests like CalPERS and about the infrastructure financing to come back first, which is why I suggest maybe sometime in the first quarter of 2023.
2024 or 25?
Sir.
In regards to the municipal code, the topic that we just talked about, did you just cut once like a current presentation of what is written in there now and then have a discussion going further how we can change it or?
Yes,
something
a discussion as to what
refresher-
recommendations we might
refresher
make.
and-
Yes, a refresher and discussions that we might have as to how to finesse that code to clean up make a recommendation to city council to clean up our competitive bidding for professional services.
For all services, really. Because when you get through with the city charter, with the charter changes, it's going to affect pretty much everything, isn't it?
It will impact quite a bit, yes.
So it's basically the overall procurement code that we have.
But the charter portion of that is going to not be voted on until March of 2023.
Right, right. So maybe we shouldn't even visit this until after the election. Find
Okay.
out what happens in the city charter. Because that whole procurement municipal code is probably up for grabs. I don't know what the charter amendment looks like, but I would imagine that based on what we've talked about in the past, things that are currently in the charter, we would like to see be more flexible. They should ultimately end up in the city.
There's a lot of changes.
Yeah.
So, okay, after March is fine with me, as long as we get a chance to talk about it.
Yeah. Okay. Sounds good.
Thank you. We can do big things.
Motion to adjourn?
Yep, motion to adjourn.
Second.
Before you adjourn, I just want to thank all of you again for your patience. I know, again, I've mentioned we're a department in transition. I'm doing my best to provide
all your
what I
hard work.
can, and I appreciate your patience.
It's recognized, Doug. Thank you.
Absolutely, thank you for your hard work and continuing to make this.
You're the only guy left, right?
Yes, yes.
A department.
Should we put in a message to the city council asking for Doug to get an assistant?
Bigger office.
I think the mics are turning off right now.
All right, motion to
Made a
adjourn.
motion. Is there a second?
Second.
All in favor?
Aye.
Opposed? We are adjourned.
We're adjourned.
See you in
Thank
the
you.
summer.